Good afternoon, everyone. Thank you very much for joining us for the Sign Association of Canada's webinar on navigating the Canadian Emergency Wage Subsidy Program, presented by Barry Travers and Bobby White of KPMG. Today's session is being recorded, and this recording will be available to all of our attendees today, as well as to our members afterwards. Before we begin, I will take a few minutes to review some of our upcoming events and benefits and programs that I would like our members to be aware of. So as a member, you are a member of a multidimensional association. You're a member of your region and chapter. You're a member of the Sign Association of Canada. And if you're a Class 1 member, so sign manufacturer, you're also a member of the ISA. This means that you get all the benefits and and take advantage of all the different programs that all three levels of the association provide to you. So one of the things that I keep reminding our members, and especially right now when we're working, some of us are still working from home, online learning resources are available through ISA's online learning portal, and you can get to it through signs.org/online. There is a library that is available with more than 80 online courses right now, and they keep adding to new sessions to it all the time. So one of the latest sessions that they just added was on management, leader as coach, how to bring out the best in your people. Then keep reminding, but we are very social, and we want all of our members to link in with us, connect with us, follow us through Twitter, Instagram, Facebook, and LinkedIn. Sign Association of Canada, OSA, ACI, and ASA, as well as ISA. This is the fastest way to find out what is going on with our association. Affiliate partners. So our members get exclusive discounts through our affiliate partners. So regardless of where you are in Canada, your membership gets you discounts on everything from car rentals to credit card processing and shipping and sign job flow estimating and quoting software. So that's Sign Tracker that we just added to our affiliate partners roster. And our members tell us they have more than paid for their membership with just one discount program. So depending on what your sign company does, just look through this list and see what is appropriate. With regards to upcoming events, pencil in September 25th, because that's when we are going to have our virtual night out at the BOCSles, and we're going to be celebrating the best of the sign industry. While we're not able to meet in person, we are looking very much forward to our virtual event, and we received a record amount of submissions for the awards this year, and I wait to see the finalists. So you can register already right now online at sacace.ca, and you will see already on homepage the little icon. Click on it and register. Two upcoming events. One is on September 15th, and it's How Women Rise. It's a Breaking Barriers session, and presented by Glyne Roberts-McCabe. She will talk about 3 ways that women unintentionally limit their influence and impact, and 3 ways they can strengthen their position. Do make sure to register. It will be a great session. And after that, our upcoming SAC webinar will be on SEO, how to rank on Google in 2020. And that will be on Wednesday, September the 23rd at 11 o'clock Eastern Time. So without further ado, we do want to, because I know that this is going to be a jam-packed information session. As a Canadian employer that has been affected by COVID-19, the Canadian Emergency Wage Subsidy, or CEWS, may enable you to rehire or keep your workers and put you in a better position to resume operations in the months to come. However, determining eligibility and understanding the nuances of the subsidy to avoid government penalties if your application is later deemed invalid, can create a high level of stress and uncertainty. So there's also this information out there, and it's really sometimes difficult to digest it all. So today's presentation is especially timely as the Government of Canada just launched an updated CEWS calculator to support employers. And also the applications for the next period of CEWS program are being accepted as of August 17th. So we are here to discuss a myriad of things that go with this topic. I will introduce our speakers. So our speaker is Barry Travers. He is a partner based in KPMG Bay Adelaide Centre office in Toronto. In addition to his role as national leader of the public sector tax practice, Barry is also the global and Canadian leader of the infrastructure, government, and healthcare tax group. Barry has extensive technical knowledge in the Canadian emergency wage subsidy, temporary wage subsidy, GST, HST, QST, and income tax. Wow, that's a mouthful. Barry leads the income tax component of our of KPMG's comprehensive reviews. And he's also joined by his colleague, Bobby White, who will be, in case some specific questions also come up, she will be chiming in. Bobby White is a partner in the KPMG enterprise practice and has specialized in serving owner-managed professional services and public sector clients for the past 23 years. She's a member of the firm's Department of Professional Practice and has been assisting both KPMG teams across the country, as well as her direct clients, with their revenue calculations under the Canada Emergency Wage Subsidy Program since its introduction at the beginning of the pandemic. So without further ado, I'm giving the proverbial mic over to Barry and Bobby. And yes, thank you very much for joining us today.
Thank you, Corinne. We very much appreciate the invitation. So as Corinne mentioned, we do have a little agenda of information to put together to give to you today. And Bobby and I will do this together. And just by way of what skill sets we each have. So I'm the tax person, so I've dealt with the legislative aspect of it. Bobby is a audit partner, and so obviously a specialist in accounting. And so accounting as it relates to the revenue and the revenue decline tests that the tax legislation requires, that's her expertise. And so we tag team on these things together in terms of our various backgrounds. So what we thought we would do over the course of probably the next 40 to 45 minutes or so is spend some time doing a little bit of a recap of the old CEWS, the original CEWS. I'll probably call it old CEWS just to distinguish the two. And then we want to do that ever so briefly to be able to kind of have a foundation of where we're at prior to the new rules having come in, because there is some overlap in periods 5 and 6 between both programs. And then we'll talk about the new CEWS and the updates for the new program that begin in period 5, so the month of July. We'll briefly spend some time talking about some legislative updates outside of these that were introduced as part of the last bill C20 that was put through, and then we'll make sure that we leave about 10 minutes bare minimum for questions at the end, so people can put their questions in, and I believe they put them in, and Hillary will read them to us at that point in time. So that's kind of the game plan for the session. So in terms of the recap, just to kind of go back to the original program, and as I say, this is relevant because it clearly was applicable for periods 1 through 4, so March through June. It continues to be available for July and August to the extent that you qualify, and I think you'll see that the old CEWS had some features to it that were quite attractive and beneficial that are not necessarily present in the new CEWS. And so while the new CEWS is applicable probably to more organizations, it may not be quite as rich in terms of potential payout. So the original CEWS was a program that provided a 75% subsidy on wages. The maximum was $847 a week that you could get under the program. So that was kind of a limit that they set. And it was all based on a decline of revenue that was, as and many described, a cliff, if you will. So if you had this 30% revenue decline, either year over year or the current month to the average of January, February of 2020, and you're able to pick which of those comparators you used. It was 15% in March, and then obviously jumped to 30% revenue decline starting in the next month up until the end of June, and then subsequently the program was extended for the summer months as well. So, many organizations were frustrated by the fact that they would have a 29% revenue decline, and that would not avail themselves of the program. And so, that was part of the big reason for the change. As I mentioned, the original program well, it was initially 3 months. It was ultimately extended to be available for qualifying periods up till August 29th, 2020. And one of the features in the program, and I'll refer to it several times, is this concept of baseline remuneration. So that was remuneration that you had to use in the calculation that had been paid to employees for the period of January 1st to March 15th. And you'll see that as we go through the presentation, there's actually new baseline periods that were introduced. And that was very relevant, that concept, because in the formula, that's what allowed for the first 100% of the first 75% of somebody's wages to actually be paid out by way of a subsidy. So many organizations had reduced pay for some of the individuals in their employ by 25%, and so they were able to get a subsidy on that 75% of what they were paying them in full. And that concept of baseline remuneration in the new program, new CEWS, is gone as it relates to employees, unless those employees are related to the business, so non-arm's length employees. In the case of non-arm's length employees, there was limitations that you needed to have baseline remuneration to get any amount of subsidy. So this is kind of just a recap of how the previous old subsidy worked, and as it was the greater of two aspects of a formula, and you can see the very relevant part that I've highlighted in red in the second part was this concept of baseline remuneration, because that was one of the basis for getting this first 100% of the first 75% of pay. In the case of an employee, so an owner manager, someone that was dealing at non-arm's length with the business, so the primary shareholder, if you will, that had a controlling interest in the company, that person, in order to receive any form of subsidy, they needed to have some amount of baseline remuneration. They need to be paid previously. So as I say, in the March 1st to 15th period, or the subsidy was simply not available to that individual because they had no baseline remuneration. So even though you might have paid yourself, if you didn't have baseline remuneration, you got no subsidy. And that concept, that does continue in the new program as well. And just to recap on the revenue reduction test components, and this is really Bobby's expertise. There really has not been dramatic change in this area. There's certainly change as it relates to the comparator periods, but it's essentially revenues that you've earned in your business that are from arm's length sources. So you couldn't have non-arm's length revenues or related party revenues included. And it did exclude extraordinary items and items that are account of capital. So capital gains were not part of your revenue for your primary period or your comparator period. And there were a number of elections that are available under that program that continue to be available under the new program. So they really didn't tinker too much with how you calculate revenue in relation to the new program, but certainly now it comes down to a very granular amount when you're doing your calculation. So that's a little bit of a recap just to kind of set the stage for what has changed as we move forward. So under the new program, the program has now been extended out to what appears to be 10 periods. We know that there will be 9 periods for sure. And we'll show you in a minute a slide that actually breaks down, and Bobby can go through and show you the actual period by period basis that the new periods constitute for periods 5 through 9, which will carry us through to November 21st, 2020. Within the legislation, they've actually contemplated adding a prescribed period, so a period 10, and they've actually said in the legislation that that can be any time up until including December 31st, 2020. So there's no mention of this date that I have on here of December 19th, but we're kind of guessing if they were to add on a period 10, that 4 weeks from November 21st would actually be December 19th, but they could make the final period 6 weeks if they so chose, because the legislation allows them to do that with that deadline date of December 31st. All filings for all periods for CEWS must be in by January 31st, 2021. We have many clients who have not made their claims for period 1 yet, and they're kind of taking a bit of a wait and see approach. They obviously are in a position that they don't need the cash flow right away, but they're kind of making decisions as to whether how they should best go about analyzing their revenue decline. So they're kind of waiting, and they're going to do all their claims at once in the fall or even in January. And as Corinne mentioned, the for period 5, the submissions will be open to be input as of August 17th, so next Monday, through your My Business account, your CRA My Business account. So the new program really is designed to be a combination of 2 levels. So there's what they describe a base subsidy and then a top-up subsidy. And each of those subsidies are calculated independent of each other. And we'll go through a couple of examples and show you how they're calculated, but they're two totally different calculations to determine what each aspect of the subsidy is, and you combine these two together to actually come up with your effective CEWS rate for a particular month. So the idea, certainly in the summer months, in July and August, is that the maximum subsidy that would be otherwise available under the new program is achieved when you get to an 85% eligible remuneration. So you do that at a level of about 70%, 75% revenue decline because of the factors that are involved, and I'll show you how those work. But it's designed that is the maximum. Now, comparing it to the old CEWS, when we do that, remembering that it was a 75% subsidy, in many cases with the 30% revenue decline, getting a 75% subsidy, as was the case under the old program, that likely will end up being more dollars for July and August. But if you aren't at the 30% revenue decline, like you're not quite that high, then certainly the new program is what will be available for you to use in July, August, and going forward. So we'll go through and we'll look at actually how the program breaks down. But before we do that, I just wanted to reinforce the fact that what they referred to in their backgrounder as the safe harbor rule, this is really allowing the old CEWS and the new CEWS to operate side by side for the months of July and August. And effectively what you will do is you're able to calculate old CEWS and new CEWS, and the CRA have this on their calculator that Corinne mentioned is now on their website. It's been updated. You're able to go through and do that on an employee by employee basis, and you get to pick the greater of the two on an employee by employee basis. So whatever subsidy program in those 2 months, July and August, produces a greater result on an employee by employee basis, that's the one that you're able to actually claim as your subsidy. And I think it was probably appropriate that they made that decision. There was a lot of organizations that had made commitments to employees during the summer months. They knew the program was going to August 29th. And so providing the option to use either one, whatever produces the best result, was the right answer. One thing they did do under both programs, and this was important for organizations that had people that worked for specific periods of time, is that previously there was a rule that said that you could not be without remuneration for 14 or more days in one of these qualifying periods. So each of these qualifying periods that we refer to as period 1, 2, 3, 4, they're 28 days. So they're not actually the calendar month, they're 28 actual days. And if you had somebody that was without remuneration for 14 days, they qualified for no subsidy at all. And businesses that were like camps, where they, the mines in northern Alberta, for example, that was very regular that they would have people come on and work 14 days and be off 14 days. So those employees were not eligible for the program. So they got rid of that. So effective July 5th, going forward, either under the new program or the old program, that 14-day rule is gone. So that makes it a lot easier to access the subsidy for those types of organizations that had those employees. So this is a bit of a snapshot, and we'll go through first the base subsidy and then the top-up subsidy separately, and we'll speak about each of these periods and then run through a couple of examples with you. So the base subsidy, you can see, is available to an organization that has a revenue decline of 0 up to 49%. So if you have any amount of revenue decline, when you go through and do your computation of comparing year over year or the current month to the January, February average, and if we look at period 5, for example, Let's say we've got an organization that's got a 25% revenue drop in the month of July, so period 5. So what happens is they say, okay, well, I take my 25% revenue drop. I'm able to apply a factor to that of 1.2, as noted on the slide in that box. And so therefore, my base subsidy rate for the month of July is 30%. So 25% multiplied by 1.2 gets you 30%. So that's available. The base subsidy is available and maxes out essentially when you hit 50% of a revenue decline, because a 50% revenue decline multiplied by 1.2 would get you to a 60% base subsidy rate. And remember, this is just the base subsidy. So that's the maximum that's available in July. You can see that the factor of 1.2 remains in August, but then it starts to go down. So it goes down. September is the factor is now 1 multiplied by your revenue drop for that month, 0.8 for period 8, and 0.4 for period 9. And we suspect that if they were to add a period 10 in December, that revenue drop factor, if you will, it would likely be dropped as well. And what you're multiplying when you come up with your actual subsidy rate is that the maximum weekly subsidy, you can see the remuneration that they believe that the maximum should be based on is $1,129 per week. So that's effectively what you're applying your factor to, so your subsidy rate to. So you can see that where you have $1,129 and let's say you've got a maximum factor of 40% in period 7. So if you were multiplying that 40% by 1129 for period 8, that would get you a maximum subsidy per employee of $452. So you can see that after July and August, the maximum subsidy that's going to be available per week per employee is going down, just sheerly due to the fact that the factor is declining starting in September. So that's the base subsidy, and that's, as I say, that's a single month being compared to the prior year or January, February. When it comes to the top-up subsidy, that is looking at the activity or the revenue for the 3 preceding months. So it doesn't actually even include the month that you're looking at. So if you're looking at July, for example, when you're looking at July's activity, in the case of the top-up subsidy, you'd actually be taking the revenues for April, May, and June, because those are the 3 preceding months, and you'd compare your April, May, and June of 2020, you'd compare that to either April, May, and June of 2019, and calculate your revenue decline based on those combined months, the average of those months, or again, you're able to use your January, February average as your comparator. But one way or the other, that's the examination that arrives at the top-up subsidy. And obviously, you're only getting into the top-up subsidy if your revenue decline is in excess of 50%. So the top-up subsidy, unless you've got a revenue decline in that 3-month period that you're examining, the average of those 3 months, then you simply don't get into it. So let's say for an organization that's got a 65% revenue decline in its 3 preceding months compared to the prior year, when it's doing its July calculation, that would translate through to an 18.75% top-up rate. And how that would have been achieved, as you can see on that second line, you take your 65% average revenue decline for those 3 preceding months, you back off 50%, because the 50% is essentially what they are otherwise rewarding you through the base subsidy. So the net amount is 15%. You multiply that 15% by a factor of 1.25, and so that's how you get at the 18.75%. So when you're calculating your effective subsidy rate, you take your base subsidy that you've calculated and you add to it your top-up subsidy if you were eligible for that type of subsidy, and the 2 combined is what you're applying to your eligible remuneration, up to $1,129 being the maximum. So that's effectively how the subsidy works. So you can see that an organization that I just alluded to in July, let's say, it only had 25% revenue decline, it would get a base subsidy in that case of 30%, forgetting about any other deeming rule. But if it had really low revenues in the 3 preceding months, it could also get a top-up subsidy. So it's not necessarily because the two calculations are looking at different periods, if you will. You do have to examine them separately as opposed to doing them on a combined basis. But you do ultimately add the two numbers together at the end. So this is, I'll just introduce the concept, and then I'll let Bobby speak to how it works between the periods. So you may have recalled that previously there was a deeming rule in the early part under old CEWS. Let's say you had been eligible because you met the revenue decline test of 30% for the month of May. That caused you to be eligible to claim the subsidy also in June. So you didn't have to redo your calculations for June. So they kind of kept that concept in the new CEWS as well. And how they did that is they're allowing an organization to use the revenue decline for a particular month and look at your preceding month, and you get to use the greater of those two figures. So let's say we've got an organization that has a revenue decline in July of 28%, and that same organization has a revenue decline in the month of August of 22%. So when they're doing their July calculation, forgetting about any other deeming rule, they would use 28%. When they're looking at August, because they're allowed to look back at their preceding month, instead of having to use 22%, they're able to use 28%. So you can always look to your preceding month revenue decline, and if that happens to be higher than the current month, then you're allowed to use that preceding month revenue decline. And the only other thing that this slide is introducing is the fact that the comparator period that previously was that you chose for periods 1 through 4, being either the prior year or the January-February 2020 average, they've actually now given everyone an opportunity to switch. So let's say you're using prior year all along. Now, if you want to switch for periods 5 forward and use January-February average instead, you're able to do that. You've got to be consistent through the remainder of the program, whatever you do switch to, or you can keep the same, but they are allowing a one-time switch opportunity of your comparator period. So with that background, Bobby, I'll turn it over to you to kind of explain the nuances through the periods.
Okay, thank you very much, Barry. So as you can see on this slide, it's a visual of those time periods that Barry just spoke to in terms of the revenue drop for the reference period. So taking you through period 5 through 9. So again, period 5 is July, period 9 is in that November time period. And you can see on this slide, for instance, on the first line for July in particular for period 5, you have the option, as mentioned, for that reference period, which tends to be the standard go-to reference period of comparing to the prior year as opposed to the alternative reference, which is looking at the January and February average for 2020. So I'd mention one thing here is for you to choose very carefully. So as Barry mentioned, this is a strategic decision to look at your business trends, your prior year, as well as your January-February average, and choose as to which one would be a more beneficial period to compare to maximize your percentage. So I want to caution everyone who's listening that revenue percentage decline, as you can see in those calculators that Barry has in the previous slides, that percentage now will drive your dollars under the subsidy. It's part of the formula, it's part of the calculation. In the old CEWS, you would have been really more interested into whether you were under or over the 30% threshold, for instance. But now that revenue percentage is very precise and is within the calculation. So Barry, if you can move to the next slide, I believe this is the top up. So for that top up, that 20%, 25% potential top up subsidy, again, you're looking at that 3-month average. So a little bit different from the last one. Now you're looking at the reference period of being the 3-month average of the prior year, or looking at the January-February 2020 average. So again, for periods 5 through 9, that top up is available for those organizations that had a revenue decline of greater than 50%. And on slide 12, you saw the formula as to who would be able to maximize that 25% subsidy, and that would be 75% or greater revenue decline in either this reference period or the alternative period. So again, choose between one of the two methods. Whatever you choose under your base on the previous slide for the base calculations as well as the top up, you need to be consistent between the two, and you also need to be consistent over the remainder of periods 5 through 9 as you work your way through. I just want to very briefly mention that the revenue decline percentage cannot be rounded. So you will notice on August 11th, a couple days ago, CRA did update their frequently asked questions on the website. And there's one particular question, it's question 20.5, for those of you who would like to have a look, that if you had a revenue decline percentage of, let's say, 29.96, you can't round that up to meet the 30% threshold. Or under the top up, if you had a 49.9%, for instance, decline, you can't round that up to 50% to meet those base thresholds or the safe harbor rules. So as I mentioned, those revenue calculations are very sensitive and should be looked at carefully to make sure that you're calculating them appropriately. Back to you, Barry.
Perfect. Thank you, Bobby. So it's always helpful to go through a little bit of an example in terms of trying to understand how these rules work. So we thought it would be useful to do that, to provide a couple of examples. So the first example here, we've got an organization in period 5. Let's assume that in June, they otherwise did have a 30% revenue decline. So that would cause them to be deemed to qualify for old CEWS for the month of July. Despite the fact that the new program is in place. But we're also told that they do have a revenue decline of 45% on their current activity in period 5 in the month of July compared to the prior year. And in addition, they had a 3-month decline of revenue for the prior 3 months of April through June of 60%. So they're really going through and trying to understand what's the basis, are we better to use old CEWS or new CEWS for the month of July in terms of making our claim, given that they have that option. So to calculate their base rate, you first of all take the revenue decline of 45% and you multiply that by the factor that's available for the month of July of 1.2. So that's what gets them to a effective base subsidy rate for July under the new CEWS of 54%. They take the top-up subsidy calculation and say, okay, well, I have a revenue drop in the 3 preceding months of 60%. I back that off by the 50% that I'm required to in the formula, and I take that net difference of 10%, multiply it by 1.25. So therefore, my top-up subsidy rate is 12.5%. So to come up with my overall new CEWS effective rate for the month of July under new CEWS, you just simply combine those two numbers together. My base subsidy rate of 54 and my top-up subsidy rate of 12.5. So that gets me a overall effective rate under new CEWS of 66.5. So you can see that in terms of what the maximum weekly subsidy they would be able to receive for any one employee based on the maximum remuneration amount of $1,129, you multiply that by the CEWS rate of 66.5. So the maximum would be $750.79. So when you consider for period 5, what should they do under the old CEWS, this organization would be deemed to have qualified under the 30% revenue decline for the previous month. So if you recall some of the numbers that we had looked at under old CEWS, the maximum weekly remuneration limit under old CEWS was $847 a week. In this case, we're told that a particular employee is receiving $800 a week and they had baseline remuneration of $825 per week. So therefore, one would suspect that the amount of subsidy that they will be able to receive under the old CEWS will be greater than what they otherwise would be able to receive under the new CEWS at being the 750.79 maximum under new CEWS. So I think the moral of the story here is that it's worth the exercise unless you've got a revenue decline that's in excess of 77% for the month of July. I would suspect in all other cases, you're going to find that the old CEWS is going to be the preferable route to go if you qualify for that, for the safe harbor months of July and August. That's the numbers we've done, quite a few numbers run, and that appears what's kicking out to this point. So let's kind of fast forward with this same organization and take it forward to September. So now we know the old program is gone altogether, and so they're only reliant on the new CEWS. And so in this case, we're told that in period 7, they've got a revenue drop of 25% for the current period. We assume that they had that same revenue drop of 25% for period 6 in the month of August. So going back to what I had said previously, they get to pick the greater of the two, but given that they're both the same number, that the revenue decline that they're going to use for calculating their base subsidy is in fact 25% in September. So in terms of the actual base subsidy amount, we know our factor amount has now dropped to 1. Previously it was 1.2, but for September it's down to 1. So you take your 25% revenue decline, multiply that by the factor, so your base subsidy rate is 25%. In this case, we are told that they still do have a revenue decline in the 3 preceding months, in this case June through August, that amounts to 55% from the prior year. So their top-up subsidy, they still will get a top-up subsidy because it's in excess of 50%. And that's again calculated by taking the actual amount of the revenue decline on top up for the 3 preceding months of 55, backing off the 50% as we're told to do, multiplying that net difference of 5% by the factor of 1.25. And that 1.25, remember, that factor does not decrease over the remaining months of the program. They've kept that one constant for purposes of the top up. So that gets them a top up subsidy amount of 6.25%. So you add the two together. So their effective CEWS rate for the month of September is 31.25%. When you apply that to the active employees with no baseline remuneration as a concept any longer, so an active employee maximum of 1,129, that would mean that the maximum subsidy that they could receive would be $352. So, if you think if somebody was actually paid, and that's a weekly basis, if the actual person was paid $800 per week in the month of September, that's the number you'd be multiplying by 31.25%. So again, it's a lower subsidy because now we've dropped down to 31% compared to previously the subsidy rate being 75%. So the numbers are going to decline in the fall months regardless, simply due to the fact that the factor is dropping down in those fall months. So those are a couple of examples of just illustrating how the numbers work. Some things that we do want to point out that are really important that have been changed in the program is now how they look at the difference in terms of an active employee, one that's actually working, and somebody that's on leave. Previously, an employee that was on leave that you brought back perhaps wasn't working, you were closed, but you still continue to pay the person. That person was considered to be on leave, but to the extent you were paying them, they were fully eligible for CEWS. You were eligible to claim CEWS on the actual pay that you made them. So there was no distinction between whether an employee was on leave or not as it related to the subsidy calculation. The only thing that you did get under the old program was when the employee was on leave, you were able to claim back the employer portion of CPP in EI. That is now there is a dramatic difference in the sense that the legislation actually calculates active employees and employees on leave very differently. So for an active employee, somebody that's an arm's length employee that's an active employee, we'll look at non-arm's length in a second, but for somebody that's an active employee, so in other words, working, as we've said before, they will continue to qualify for old CEWS for July and August if you've met your 30% revenue decline, either in those months or in the preceding month to kind of meet the test. But then when we get into the fall months, in their case, it will simply be how much you've paid them. So what their remuneration is multiplied by whatever your effective CEWS rate is for that month, base and top up, if you're eligible to claim both. And what you pay them is the amount of the subsidy that you will receive. So the concept of baseline remuneration for these employees that, as we saw in the original formula that kind of drove up the subsidy amount, that's gone, totally gone for active employees that are dealing at arm's length. For active employees that are dealing at non-arm's length, so in other words, somebody, an owner manager, as I've said before, again, for July and August, the old program continues, the same concepts hold true, nothing changes in that regard. But under the new program, whether you've got to use the new program in the summer months or you'll definitely be using it starting in September, they continue to be required to have baseline remuneration. So it's really the only employee group at all that ever baseline remuneration does continue as a concept. And the reason for that is that if you did not previously pay somebody that was a shareholder remuneration in a preceding period, so in a baseline period, you were ineligible to receive the subsidy, and that continues to be the case. So their eligible remuneration is considered to be the lesser of what you actually pay them, or their baseline remuneration for a qualifying period up to the maximum of $1,129. So they've maintained this concept of baseline remuneration only for non-arm's length active employees. For employees that are on leave, what they did with this group is that in actual fact, an employee that continues to be on leave for the summer months, for July and August, to the extent that the organization has any amount of revenue reduction, so not even the 30% threshold as was the case under the previous program, just any revenue reduction at all from the prior year or the January-February average, whatever comparator you're using, what they're doing is they're allowing the organization to avail themselves of old CEWS just for July and August. So you get the full 75% subsidy on pay that you've made to an employee on leave for July and August. But then starting in period 7 going forward, when old CEWS is gone, now these employees that are on leave, they will not be able to receive an amount that's calculated based on the actual revenue decline. So there's no CEWS rate that's applied to them. Instead, what they've told us and what the legislation contemplates is that these employees, if you continue to pay them, that the organization will be able to apply effectively for what they're calling a prescribed amount, which has not yet been determined. So they haven't actually announced it yet, but they've said that it'll be in line with what the individual may have been receiving under an employment program such as CERB or EI. So our guess is that it will be $500 per week. Certainly it will be no more than that because that's what they would have otherwise got under CERB. But if the organization has any revenue reduction in the fall months, then the organization, to the extent it is paying somebody on leave, will be able to apply for this prescribed amount up, and that's a maximum as to what you're actually paying them. So if you're only paying them $300 a week, you could get no more than $300 a week, but up to a maximum of this prescribed amount, which we believe will be $500 a week. So that's how they're dealing with employees on leave. They're basically taking them out of the calculation portion of the program. The baseline period. So this is important for, as I said, an owner manager. So originally the default period and what continues to be the available period for all periods is on the left-hand side. So January 1st to March 15th, baseline remuneration for an owner manager is relevant, and of course it's obviously all relevant through to period 6 under the old CEWS. But once the old CEWS goes away, starting for sure in period 7, then baseline remuneration for active employees, as I said, just becomes a non-issue. It doesn't factor into the calculation, so it's only applicable for non-arm's length employees at that point. But they did introduce a number of alternate baseline periods because we had a lot of feedback that some organizations simply were seasonal businesses. So, January through March just didn't work for them. So they did introduce the first alternate period that you can see that was only available for the first 4 periods. But then subsequently in this new legislation, they've introduced a second alternate method, and then finally a third alternate method for the balance of the periods going into the fall. So that alternate final method of July 1st to December 31st, 2019, that would only be where an owner manager didn't otherwise have remuneration in the other baseline period. And so they're able to look at this period to determine baseline remuneration. But remember, baseline remuneration, and this continues to be the case today, is actual salary paid to these employees that are non-arm's length employees, where tax was withheld and remitted, and it's reported as salary income. So there was a lot of discussion as to whether dividends or interest that were paid to a shareholder could somehow or other be treated as salary or retroactively changed to salary to be able to count as baseline remuneration, and that was never adhered to, never opened up, never changed. So dividends paid to a shareholder simply do not count as baseline remuneration because it was not reported as salary remuneration at the time. And we've had clients, asking as to whether they can retroactively go back and change, and the FAQs make it very clear that's simply not the case. So that's this is just a bit of a summary in terms of what we've described to this point in terms of all the different periods. Oh, what happened there? I keep trying to move my little cursor here beyond the my picture is in the way of what I'm trying to say. So this is just a summary of the periods to this point, periods 1 through 4, 5 and 6, and then 7 through 10. So basically it's a summary of what you do with active employees and inactive employees or employees on leave. So you can see that, everything's pretty consistent until you get to periods 5 and 6, where things start to change. Both are available during those months for active employees, but inactive employees just have the old CEWS, and then starting in periods 7 through 10, it's simply the new CEWS that are available for active employees, and those employees on leave will just get this base amount that otherwise is going to be a prescribed amount. So in the next couple of minutes, I'll just go through the other legislative updates. So there was a provision that was brought into play for asset purchase arrangements. So let's say a new business was set up, new corporation was set up, and they bought assets from a vendor, and they continue that same business. Previously, they had no comparator revenue because it was the seller who actually operated the business. So they put something in place that allowed for the purchaser of a new business to actually take the information of the revenues from the vendor of the business to use as their comparator to be eligible. So that was a bit of a positive step. They introduced an appeal process for people that don't agree with their claim and how they'll go about appealing claims that are otherwise denied. And we've seen some of those, unfortunately, that they are being pursued. There was some exclusion of government revenues for certain Aboriginal businesses that probably wouldn't relate to you guys at all. They did make flexibility in the use of the cash or accrual method. So previously, everybody that was on accrual were given the choice to use cash method, which you had to use throughout all periods if you chose to do so. But some businesses that were on a cash basis previously didn't have the option of switching to accrual. So they introduced that as an option that is otherwise now available. So, but you've got to be consistent for all 10 periods, regardless of which one you pick. There's certain arrangements that cropped up where an organization didn't have its own RP account. So they otherwise were eligible, but since they didn't have their own RP account, like their payroll was paid by another organization, they were kind of hooped to begin with, but they fixed that so that there's now mechanics that that organization that didn't otherwise have an RP account is able to get a payroll account and will be able to make a claim and have their information transferred over. They put a new rule in dealing with amalgamation, so situations where companies were combined together and they formed a single business now. So now you're able to go back and look at the predecessor entities and basically add those revenues up to be your comparator revenue. So that made it a lot easier. They introduced some rules to expand that the program is available for trusts. that are otherwise, unless they're otherwise exempt from tax. So trusts can use the program, and seasonal employees were dealt with through the baseline remuneration changes. So a lot of those changes were really introduced for seasonal businesses to ensure that those businesses that didn't have payroll in a certain period had some options to choose from to come up with their baseline remuneration, as I illustrated to you. And then there were some changes to statutory time deadlines up till December 31st, 2020, which is really just technically in terms of how you're able to process information to be able to make the claim. So that's kind of a summary of the old program and the new program. So we've brought ourselves to 10 minutes before the hour, so we've left enough time for questions.
Folks, if you have questions, you can type them into the Q&A field, which is at the bottom of your screen. I did receive one earlier that I'm going to read out. Bear with me. Do you have recommendations about who owners should go to help them figure out these calculations, if it's their own accountants or bookkeepers who are not well versed in it?
Well, I have no choice but to say KPMG. Like I'd be bound. Bobby would tell on me and get me into big trouble if I said something different. So, we are obviously helping, hundreds, thousands of organizations across the country with this program. So, it is complicated. They didn't do anything to make it easier, that's for sure. As you can see, like we tried to make this as explainable as possible, but the legislation and I think it's what we've seen with organizations. It's some of the elective options. Like organizations are not necessarily understanding that there are elective options that they can make that would enhance the amount of their claim. So they're kind of just putting in the numbers that they think are right and not really understanding a lot of the elective provisions. And that's where we're helping organizations to, increase what they otherwise would be able to get. So us or your advisor basically is the right answer.
Excellent. I am not seeing more questions coming in. So for our attendees, you do still have the chance to type some questions into the Q&A field. And if we don't have any, then maybe it is time to wrap up. Barry and Bobby, do you have more in summary?
Barry, if I can just quickly mention, and perhaps Hillary, one of the prevalent questions that we've been receiving on the revenue side is normal accounting practice and how to properly calculate the month-to-month decline, and especially under these new rules, because that percentage, as I mentioned, is very important to the calculation. So you do have to perform a proper cutoff on each month that's being measured. I think that's important for everyone listening and everyone who will listen to the recording as well, that there's some work behind that. Certainly more work than you would typically have in your normal accounting month. It's very much like every month is a year end to make sure that you've got those numbers in the right place. That will be critical, especially when your subsidy is eventually audited as well by either CRA or your auditors coming out to look at your books and records.
That's a very good point. Thank you for that one, Bobby. We do have one in the chat bubble. It says, they have consistently refused us to deduct our work share payments. We don't receive these figures from EI, and even estimating, we don't know how, we don't know if the employees are collecting. What do you suggest?
So, it's a good question and an interesting question. We've had this situation arise. The only way to do this is to talk to the employees, because if you've got a work share program, then there is a requirement to reduce the amount of what's been received under the work share program as part of the CEWS claim. So, the only manner that you can collect this information, if you can't get it through Service Canada, is directly from the employees. And that's a bit of an arduous task. They obviously know that you're part of a program if you're registered in the program. So, attempting to gather what that information is from the employees is what most organizations that we're dealing with have done to try to get the number in there and get it right.
Well, thank you very much. Thank you to both of you, Barry and Bobby. It's been really helpful. There's a ton of content in there that we will be sharing both in the recording and the slides with everyone who's signed up. And I want to thank both of you for your time here today. It was an excellent presentation. I'd like to thank our attendees as well for attending, and hope all of you enjoyed it and that you got as much out of it as I did. And we hope to see all of you on some upcoming sessions. Take care and have a great day.
Thank you.
Thank you.